Hey everyone, we are live. This is Liberty in Finance, and I'm your host, Elijah K. Johnson. We are live with Gold Silver Pros Robert Kientz. Robert, thank you so much for joining us today.
Elijah, thank you for having me back on the program. I appreciate it.
Definitely. It's great to have you, and we really want to get your perspective on the rally we're seeing today and really the rally we've been seeing in the metals since the silver squeeze. We had you on about 2.5 weeks ago, silver squeeze May 1st, silver squeeze 2.0 on the 10th anniversary of the crash we saw in 2011. A lot of people were piling into the physical silver market on that day and continue to. And we had you on last time because we were looking at the market open and we were saying, well, is it going to pop like it did on the first silver squeeze? And it didn't. But you were saying that it's going to be a delayed response in the market. And that's really what we've seen. Since we last spoke about 2.5 weeks ago, silver is up about $3. What do you make of what is happening today and what has happened in the last few weeks for the silver market?
Yeah. So just to recap from the silver squeeze 1.0, just going back to late January, February, when a lot of the Wall Street silver and the retail silver investors came in, they came into SLV and other derivative products. And SLV is a price indicator for the COMEX market. When people see inflows in SLV, it tends to affect the price of the futures market, which is really what determines spot along with the London OTC. So I think the first silver squeeze, we saw 110 million ounces in 3 days, move over into SLV in terms of demand. And that caused a noticeable increase in the price of silver until the following week, a lot of the ounces came back out. And what I and a lot of other commentators are saying are, if you want to get derivative exposure to silver, it's okay to go in SLV, but it's not, you don't have direct access to silver. And we were telling people, a lot of us were telling people, commentators, hey, if you really want silver, go get the real deal. So there are alternatives to it. You can buy the physical. Of course, we saw the premium spike on physical, and I'll get into the high premiums here in a moment, if you don't mind. They're really high today in particular. But we also saw that trade come into the COMEX, and people were taking physical off the COMEX. So since the last 3rd of February, there's over 40 million ounces actually taken out of COMEX vaults. So there's been a run on physical silver, and that was really wave 2. We said that it was going to take multiple waves for this silver trade to finally play out. And I think it may be between 3 and 4. I think we're right in the middle of wave 2. And that is where people are actually going from the derivative product into physical silver, whether it be buying at retail, big guys are going to COMEX. Some people are buying PSLV, which is the Sprott closed-ended fund that has access to physical silver. I believe that's over the number on the Sprott as I look at it. They're over 143 million ounces. It's almost 4 billion total net asset value now in the PSLV. So lots of physical demand going into silver. I think there may be another wave or two coming. I think the third wave will be movement into the heavy 1,000 ounce bars. We've already seen that premium start to rise. And I think that'll be third wave. And then I think we'll get even tighter in the silver market. And I think the fourth wave could be when we have some sort of financial crisis and you have incredible investment demand. However, I think by the time we get to the fourth wave, most of the actual available physical silver is going to be gone.
Now, with respect to what we're seeing happening in the markets right now, kind of on a technical level, silver is breaking above $28, which is, a key level. What is your perspective on where we could see silver go from here?
So what we like to do on our channel is look at the technicals. And what I've seen since last August is sort of a range trading market in silver, but there was a bull flag pattern. And what that basically means is silver had been capped straight line across at about 29.50 and hadn't risen above it. But the base of the price since last March all the way to, I want to say this March, over a year, had been rising. That's a consolidation pattern, meaning people are consolidating, they're taking their profits on silver, but overall it's very bullish. There was a secondary flag pattern that started then in July to this August, which was an even sharper pattern. And that's been followed up since December, a head and shoulders pattern. And what a head and shoulders is when you have a rise and then a higher rise and then another rise. And we just got the formation of that shoulder pattern today. All of those signals I just talked about, the two bull flags and the head and shoulders, are extremely bullish. To see those come all together on the technical chart since last March, 1, 2, 3, means that I think that has been a tremendous consolidation pattern since last year. And I think it means from a technical perspective, I'm looking for silver to break out. And silver indeed has broken above its 250-day moving averages. It broke above its 50-day moving average in April. And in May, it's continued to climb. So today we're about the mid-20s in silver, not quite the mid-20s, but almost. And it is in a bull run right now. Now, how far that goes, we'll have to see. But I suspect over the next 5 to 6 months, we're easily going to break through the 30 mark. And once we do, it should run up to 32, 33, 34 pretty quickly.
Now, some people have been calling for like $50 silver if silver breaks above $30. Is that a possibility in your mind?
It is a possibility. Now, Lester, there are some longer term resistance point. I'm going to go to my chart on the long term. One of the things I do, I have a stock charts view of silver, and there is a really heavy resistance point at $30. That's like the line at which they don't want it to cross. Some of the market traders don't want it to cross. That's where people will take their profits and sell. And then there's a line at 32 and 34. And then there's not really another line until we get to 42. But each of those are weaker because they only occurred basically in the run up to silver's previous all-time high of $50 in 2011, and then on the way back down. So those, as you get higher and closer to $50, they're weaker lines. Now they still are psychological lines. As it crosses 30, 32, 34, 42, you're going to see resistance. You're going to see some selling and some profit taking. But I do think once we pass that $30, $32 mark, there's a lot less resistance to get it to 50 than there is to get it above 30. Getting above 30 is that main psychological point that we've had basically dating back to late 2011.
And again, for our viewers just joining us, we're with Robert Kientz of goldsilverpros.com. We're live today as we watch silver break above $28. Robert, did you want to kind of share with our viewers, like what portion of this move we've been seeing today and also in the last couple of weeks? It's really $3 up since Silver Squeeze 2.0 on May 1st started. What portion of this move do you think is really due to the Silver Squeeze movement?
I think a lot. So if you look at premium today, I was looking at American Silver Eagles, which is sort of like the de facto in America or North America, the de facto silver barometer. And premiums were as high as over 50% on American Silver Eagles, several issuances, not just 2021s, but previous issuances on some sites. And it was averaging anywhere from 38% premium to over 50%. Because we have a tool, Exploring Finance and I put together a tool that basically scrapes common retail websites every day, a couple of times a day, and posts those prices. And we're looking at exorbitant premiums on American Silver Eagles. And even if you go to rounds and bars, the premiums are very, very high. That means there is a really strong shortage in that retail market. And again, we're starting to see the prices on 100-ounce bars and 1,000-ounce bars start to creep up too. So you're seeing that start to work its way more to the industrial side. And a lot of that, again, has to do with it's coming off of COMEX. I want to reiterate, since the last 10 days or so of February to now, over 40 million ounces have come off of that COMEX, and it's being absorbed into other funds. A lot of those ounces have gone to PSLV, and a lot of it's just been bought out. I think it's been bought out by manufacturers looking for silver because we have overall silver scarcity. And I also think the investment demand is piling on to that. If you remember, I think I mentioned this on the last show, November last year, the Silver Institute put out a report that they expected industrial demand to drive silver another 100+ million ounces this year to over 1 billion for the first time. And that was before the first silver squeeze. And now not only do we have that increased 100+ million ounces of industrial demand, we have it in the retail sector as well. There's a lot of pressure on physical silver stocks right now. And we didn't have a lot of available above ground silver. It's different than gold. Most of the silver ever mined is now being put in industrial applications. And there's just not heavy stockpiles in a lot of places.
You mentioned the shortages developing, and this is something that Andy Scheckman, the president of Miles Franklin, talks about, is how it's getting harder and harder to source product. And we still have it, obviously, but it's getting harder and harder. And one of the interesting things about the paper versus the physical market is that on the paper market, there's more ounces traded than actually exist on a physical level. And this viewer is wanting to know, Rainbird Robert is asking, Rainbird is wanting to know, what leverage ratio exists on the LBMA silver market?
I've seen it as high as 100 to 1 or more, and it's a somewhat difficult question to ask, because as a lot of traders will tell you, and I have a lot of traders write me, when they trade, they'll trade multiple times a day. So people get in and out of contracts multiple times a day. Whatever exists at any particular moment, though, it's very highly leveraged. So I'm going to go look at the volume data for today at the CME Group, which is the website you can look and see. We had open interest of 61,000 contracts and deliveries of 186. So you divide those numbers out for May 14th data, which would be Friday's data. What's 61,000 divided by 186? It's a huge number. So right now, that derivative trading is much higher than physical. We have, however, this month had, if I look at the COMEX reports, so far we've had delivered on COMEX 7,069 cumulative silver contracts of 5,000 ounce silver, which is 35 million ounces. So deliveries, but the thing that's changed here, Elijah, in the last couple of years is that the COMEX has become a delivery market for both silver and gold. It was really set up to be a hedging market and mostly a paper market, and it's been that way since it was created. But the last few years, we've seen a lot more deliveries in both silver and gold. And I don't mean deliveries just from one participant on the exchange to the other, but silver actually coming off. And that's been a big change the last few years. And so the physical deliveries are playing a much bigger part than they ever have. The derivative price still rules the day, though. If we look at the COMEX data, the volume data for today, the settlement data, we had 83,000 contracts today, close at 28.27, another 5,000 close just over 28.3. So most of those contracts are settled in paper. It still controls the price. But when you have so much physical delivery and you have that pressure in the retail market, people are starting to figure out there's not a lot of real physical silver around. And that's why we're getting the premiums.
And when it comes to really the physical silver market, I mean, the thing is that, the paper market, there's more ounces traded than the underlying physical. But is that actually unique to the silver market? Isn't that, some people say, well, that's just how all, futures and paper markets actually work. So is that something unique to precious metals?
Well, when I passed my Series 3 license years ago, I was working at a Forex broker. The government issued training basically said the original reason for commodities markets to exist was legitimate hedging. So if you're a farmer or a metals producer producing, you want to hedge your downside risk to the price before you get it to market. If you're somebody manufacturing a product using that input, you're hedging your upside price risk because your cost could rise. That's what they teach you. But if you look at the actual trading, it's much, much higher in the paper. So yes, it's for the longest time been a paper decided market, but the original intent was legitimate hedging. Now that being said, yes, the paper does rule the day, but I think the physicals are starting to take over a little bit in this market. And I think the paper scheme over time is going to come under a tremendous amount of pressure. And I don't think it's going to last too much longer. There are signs that people are wanting to move away from some of these Western markets because of the leverage to the paper.
Now, for those, again, just joining us, we're with Robert Kientz of goldsilverpros.com. We're looking at the silver market and we're seeing how it's popping today above $28. Now, Robert, we were talking before the interview and you were saying how one of the reasons is actually inflation. We're seeing more inflation now. Did you want to kind of unpack that, why inflation has been bullish for silver and kind of your expectations for inflation going forward?
Yeah, so for the last 2.5, 3 months on my channel and in my newsletters, we've been warning people that inflation is coming for real, because we've been seeing the commodities index really pop up. We saw the Bloomberg commodity index pop up very strongly, and it reached the previous inflation level before coronavirus started. And that's before all of the economies have opened. And that was a signal that when everything fully opened, inflation was going to pop. And then just last week, it was announced, the official CPI numbers were 4% year over year, April to April, April 2020 to April 2021. That's about double what the Fed is trying to manage in terms of inflation in the economy, and it's an astounding print. Nobody was thinking 4% CPI. That's an amazing. We haven't had 4% CPI, and I don't remember how long. And a lot of people will complain about the government numbers and say they take certain things out, and I agree with that. I wrote a whole chapter in my book, Drop Shadow, about the government numbers. That being said, if you get a 4% inflation print in the CPI, that's major. And that, I think, is driving people into the precious metals, especially silver stocks that are so thin, because from investment demand, you want precious metals in times of inflation, gold and silver. Silver is the poor man's gold. From an industrial perspective, if you're seeing that inflation come through the commodities complex, you want to get your physical commodity before that price rises. And that's not just silver, that's the entire commodities complex. People are probably trying to secure the energy stocks like oil and natural gas, who have spiked. We've seen lumber spike. I mean, everybody's trying to get their commodities because of this inflation. And I think the second thing that is causing people to go into silver has to do with the LBMA. The LBMA came out recently, very recently, and announced that it overstated their silver stocks and their March market in London, and their March numbers, by 3,300 tons. It's over 100 million ounces. They had overstated, and they claimed it was just a mistake by one of the depositories miscounting. So they corrected that here a little while ago. And that took ended up being a phantom 3,300 tons of physical silver off the market. So when that happens, when you take 3,300 tons off one of the major Western markets, all of a sudden you're going to start to see that silver price rise. Why? Because you have less physical silver. And that's another signal to people they need to go get their silver. So because of inflation and because of that 3,300 phantom tons on the London market, I think that's really what's affecting the silver price.
Now, on the topic of inflation, and we're also seeing, the national debt increase at an unprecedented level. Now, Jerome Powell has actually spoken recently about this, and he was saying how, yes, the current rate of growth is unprecedented for the debt, or not so much unprecedented, but that it's unsustainable, right?
Yes.
But that eventually we could get it under control. What is your perspective on that? That maybe it's just we need to have more debt right now because the economy is weaker, but once we get the economy running, it's not going to be an issue. Your perspective on that?
Well, we live in a debt-based fiat money system, which is not tied to gold, hasn't been tied to gold since 1971. So what people need to understand is that debt grows, relatively speaking, in a fractional reserve system about 9 to 10 times faster than the actual currency supply. And currency spiked last year. About 40% of all currency printed in the history of the United States since 1913 was printed in 2020 in response to the pandemic to keep the economy afloat. So 40% of currency was printed. How much of that debt was created in that same time frame? Because debt is a multiple of currency. So we have spiked the amount of debt that we have, and I think they're at a point past no return. If you look at Kenneth Rogoff's study, once you get past 90% of GDP, a debt to GDP ratio, that basically signals the end of that fiat currency. It's one of the signposts of the milestones that it held throughout history in all other fiat currencies. We're way above that now. We're way past that now. So yeah, I understand Powell has to say that. He doesn't want to panic the market and say, yeah, the fiat currency is eventually going to die, because he's a central banker. He's trying to manage that risk and those expectations, because everybody hangs on every word he says. And so yeah, it doesn't surprise me that he's trying to make those comments, that they're trying to manage it and they can manage it. But honestly, it's never happened in history that a central bank's ever been able to manage this type of situation with the money creation and the debt. And so I don't think he's going to be able to. It's just a matter of time before we have that eventual debt collapse and that currency collapse in the United States. It's just a matter of when. And I think you see people going into the precious metals for that very reason. Gold and silver are both rising because people are starting to see, they're reading the tea leaves and they're saying, okay, we need to do something. We need to go into these safe havens.
Now, for those viewers who are just joining right now, we're talking to Robert Kientz of goldsilverpros.com. As we see today, the silver market popping above $28, $3 above where it was at the beginning of the May 1st silver squeeze. Now, Robert, one of our viewers is wanting to know about the gold-silver ratio and where you think a fair gold-silver ratio would be. We've seen really since March of 2020, the gold-silver ratio just collapsing from about 125 to about 65 today. Your perspective on where a fair gold-silver ratio would be?
So if we go back a couple of centuries of time, I would say it's about a 15-ish to 1 ratio, silver to gold. And however, in modern times, where I would say leading up to the last 20 or so years, it had expanded out to 30 to 1. But then when silver, meaning silver to gold, and then when silver got to be used more industrially, we went into the technology age and now into the space age. It's about 9 to 1 in terms of mined ounces. So that has changed over time. So if we just look at the mined ounces every year, it would be 9 to 1. Of course, the difference is silver is used industrially and put into landfills because very little minute amounts are used in millions and billions of applications, whereas most gold is above ground. So I don't know right now that there is necessarily a fair ratio if people flood to silver in terms of investment demand. I think from an industrial perspective, right now it's 9 to 1. The last 20 to 30 years, maybe it's 30 to 1. But all bets are off when people start going into silver. And I'm talking the big players, the pension funds, the hedge fund managers. When the world goes to silver and to gold as a true investment hedge, when you have problems with fiat currencies, I don't think there is any ratio. And the ratio could flip. I wrote for Seeking Alpha about 11 years ago that at some point silver could touch the price of gold. Now people would think I'm absolutely nuts. But when you look at above ground stocks of silver and the industrial and financial demand, I still stand by that. I think at some point it could. You could have an equal price between silver and gold. Now that may be some time away, but it wouldn't surprise me if eventually that does happen.
And I guess, what is your perspective on that? Because that does seem like a pretty provocative statement, right? That we could see silver equal the price of gold. Really, we've never really seen that in history though, have we?
Well, I would say in certain societies, like in Egypt, you had more silver than gold. So back when you didn't have as easy transportation, you have planes and trains, right? People used whatever metal they had as their money. So in Egypt, silver was worth more than gold, or used more than gold, essentially because it was easier to get. So, and sometimes in history, silver was equal to or used more as money than gold was. Just depended upon the situation. Now, if you look at what's happened with silver or gold, most gold ever mined is still in some sort of investable form or jewelry form above ground. There is some use in gold, particularly in electronics like motherboards and things like that, where gold is, is better than any other metal in minute amounts due to its malleability and its other properties. But silver is basically taken over for gold in industry. And so most of that silver ever mined has been used in minute amounts over billions of applications. So how are you going to get that silver back? You'd have to go scrap out of landfills and things like that. So silver is so tight in terms of overall availability and its importance to the technological society in which we live. It is just, there's extreme pressure on silver right now. And again, if we have a financial crisis, a true financial crisis, the next banking crisis, people who cannot afford $2,000, $2,500, $3,000 gold are going to go to silver. And that's going to spike the price of silver very, very high. I don't think silver will remain permanently above the price of gold, but I could see it touching on gold when we hit the next big financial crisis.
For those viewers just joining right now, we're with Robert Kientz of goldsilverpros.com. We're watching silver pop above $28. We were talking at the beginning of this live stream how this is extremely bullish on really a technical level for silver, and that you could see silver pop above $30, 32, 33. Your perspective on really, is there much downside from here? Could we see a reversal from where we are right now?
I mean, it's always possible. Hey, when you have these big paper markets on COMEX and the London OTC, yeah, I mean, it's always possible. You just throw a bunch of paper on it. And if the traders want to go short pressure, they keep putting more short paper and the longs take it and accept that paper, then yeah, the price can come down. I mean, stranger things have happened, Elisha. We popped, when you had the May massacre in 2011, we saw silver fall from 50 to 34 in a matter of days. And that was all paper trading. You see it on the chart. It was not physical trading. It wasn't everybody going to the coin stores and selling all their silver and driving the price down. It was the paper markets. Yes, it can happen. But if you look logically at what's going on, the extreme shortages of the retail silver now starting to extend, by the way, to the London LBMA market. I want to repeat what happened, what the LBMA just admitted. They overstated their March inventories by 3,300 tons of silver. 3,300 tons. It's right there on their website. They admit to it. That's a lot of silver. And you see the premiums today rise on the bullion, the government minted coins, and the regular generic coins. I mean, there's extreme shortages. I don't see in the short to medium term a lot of downside factor for silver. I just don't see it. There's such incredible pull on the physical inventories that's going to cause people to go long in the derivatives markets. Could it fall $1 here and there? Yes. But especially as it challenges 30, there are entities in the markets that don't want silver to go above 30, because when it goes above 30, it gets more expensive industrially. And if you're a Samsung or an Apple, or you're China and you're trying to build a technological economy, you don't necessarily want higher than $30 silver. So there could be participants that go short it to keep it down so that they can get the physical stocks cheaper. But that's only going to last so long when the rest of the world is flocking to silver in physical demand. So I just don't see a lot of downside risk here. And going back to what you mentioned about the technicals are extremely bullish. You have two bull flag patterns followed by a head and shoulder pattern, followed by a breakout in the 50 and 200-day moving average. That sounds like to me that the derivatives market wants to go long silver overall.
Now, in your perspective, when it comes to gold, as we see it approaching 1900 once again, where does gold stand technically?
So gold technically also has a really strong chart. It's a little bit different than silver because essentially I think it's going to pop slightly after silver, but I think silver's big move will come when gold has a big move. The thing that's happened with gold recently and just within the last few days is it's popped through its 200-day moving average. So gold is now eclipsed its 200-day moving average. It seems to have broken out of that cup and handle pattern. People who have followed me know that since 2011, there was a big dip in the gold price and then a run back up. I think we got up to almost 2070 last year. And then there was a handle pattern, which is a retracement. It's about usually anywhere from 10 to 20% retracement. That's a consolidation pattern over basically a 10-year time frame. And that's extremely bullish for gold. So from a technical perspective, I think we've broken out of that retracement in gold. I think it's now running long. I don't see anything really stopping it at the moment, especially with that inflation print. I mean, you have the inflation print, you have a lot of bond issuances under pressure, you have negative interest rates in the economy across the world. I don't see the reason why gold's going to fall back down. I think it's had its consolidation pattern. I think it's going to run. And it would not surprise me if we hit $2,000 gold again this year. Wouldn't surprise me if we hit $2,100 gold again this year. And I think if we hit $2,100 gold, you're going to see silver pop above that $30, $32 range and stay there.
Now, in the silver market, you mentioned how there were shortages developing. Are we seeing the same thing for the gold market?
I don't know if there's shortages. Now, there is a lot of demand at its current price. So I would say the marginal demand of gold is stronger than the marginal supply, meaning for every new gold ounce produced. And that's what's increasing the price. And I think people see that. And I think that's being reflected in the derivatives markets. I also think the run up to June, Basel III, where gold has gotten a little bit of different treatment, where it's a more important part of the overall banking system. I think in the last 10 years, the central banks have been buying gold like mad. I think that trend's continuing. So there's a lot of pressure on the gold market in terms of demand. Now, there is a lot of above ground stock of gold. So, you could see more frequent retracements in gold than you would in silver, especially from industrial demand perspective. But again, the world is moving to a point at which we have flooded fiat currencies, debt, negative interest rates, inflation is starting to pop in the US. Those are all extremely, extremely, extremely bullish for gold. So I don't, could it retrace a little bit? Sure. But I think we're headed to 2,200 this year for sure. And I think it's going to continue to run. There could be some corrections along the way, but I don't think we're going back to 1,600, 1,700 gold. I think that consolidation period is over.
All right. Well, Robert Kientz, it's been a pleasure having you on the show today. If people would like to hear more of these live streams, more of these interviews, they can go to libertyandfinance.com. In the upper left-hand corner, put their email and name, and you'll be notified of our newsletter and all the new interviews we're doing. And if people would like to find you, Robert, where can they go?
You simply go to goldsilverpros.com, find us on Twitter at goldsilver_pros, and on YouTube under Gold Silver Pros as well.
Fantastic. And if people would like to support this channel and acquire physical precious metals, simply email libertyandfinance@protonmail.com with your name and phone number. And once again, Robert, thank you so much for your time today, and God bless.
Happy to stop by. Thank you, Elijah.